Today's video topic is very important, which is why I have my production manager, Basher, here with me to make sure that I don't leave anything out. Also, I wanted to take a second and tell my nephew hi, so hi Milo! Now when I meet with my clients, inevitably, there are things that are unnecessarily risking their portfolio, and it's my job to point that out. In this video, I'm going to show some of the biggest problems that I'm seeing in these portfolios and how you can mitigate that risk. There are 5 big positions that I see routinely needing to be fixed, so I wanted to point those out here. The hard part for some of these is that they're not obviously bad companies or just overall crazy risk. My clients are very smart people who usually have 6, 7, 8 figures invested, but investing is tough, especially if you're investing in individual company stock, because risk can shift on a dime and your portfolio could drop like 25% in a matter of weeks if you're not careful. Remember that I'm not a financial advisor, but I am an expert in the world of finance and investing and money, and I do teach this at the university level. So if you want an extra set of eyes on your portfolio or to discuss the perfect strategy for you, please reach out with my email below at ProfessorG.invest@gmail.com and I'll send you my calendar link. My name is Nolan Govea, my students call me Professor G, and I made this channel to make investing simplified. Alright, so here's the top 5 positions for one to reconsider now in 2025. Almost all of these have to do with the fact that they're chasing returns. You need to understand that buying into a stock or a position that's gone up like 100% in the last couple months is literally the worst time to be jumping into that stock. People have FOMO and they just think that since something's been going up, that means that it's going to continue to going up and they don't want to miss out. But literally, that is the most risky time to jump into something. The first position that I see people are buying way too heavy right now is Nvidia. With a market cap over $4 trillion, Nvidia's price to earning ratio, the PE ratio, is seen as dangerously high. Its valuation is fueling concerns of overheating in AI megacaps. Strategists warn of a sharp correction if earnings fail to meet sky-high expectations. Right now, Nvidia is so high because of the expected returns, and if it doesn't hit exactly what's expected or better, then this stock could easily tumble, and so this is a very scary time to be putting new money into the stock. Nvidia is the world leader in its category and even the world leader as far as valuation of company overall, so it's obviously an amazing company, and if you bought the stock about a year or two ago, right now you're probably very, very happy. What I'm worried about right now is the valuation today and the expected return today moving forward. In order to take your investment from $1,000 today to hopefully turning it into $2,000 at some point, the company would need to go from its $4 trillion valuation to an $8 trillion market cap. In the entire world, there are only 11 companies over $1 trillion valuation, and only 3 above a $3 trillion valuation. It's possible that a single company may get to $8 trillion, but highly unlikely. And that's what's needed just for you to double your money, from going from $1,000 to $2,000 invested in Nvidia. Whereas statistically, one doubles their money just about every 7 years investing in the basic S&P 500, and this has happened like clockwork for the life of the fund over 70 years. Let me be clear that if you hold Nvidia right now, you've already bought into it a while ago or something, it's definitely not a bad stock, it's actually an amazing company. But what I am saying is that I'm seeing too many people buy into it now, starting new positions now at its literal all-time high. There are just many better stocks for you to get an overall better return in a shorter period of time. The next one on this list is not necessarily bad for your portfolio long term, so don't hear what I'm not saying. But again, what I'm seeing right now is people are jumping in now, which is just the wrong time. Right now, the overall US stock market has been shaky to say the least. As far as the entire global market, international has been crushing US stock market in 2025. The S&P 500 is up around 6 to 7% this year, while international is up more like 16 to 18% this year. Developed international equity market performance as measured by the MSCI EAFE index has been largely fueled by a weaker US dollar. For US investors, when the dollar weakens, the value of international stocks increase. The US dollar index is down 10.7% versus a basket of major global currencies. While 6-month performance favors international stocks, the US-based S&P 500 has meaningfully outperformed developed international stocks over 3, 5, and 10-year periods. So yes, right now international ETFs and index funds are up higher than a lot of the US indexes right now, year to date. And no, it's not necessarily bad to invest in international funds. But what is not the smartest thing in the world is to sell something that's down in order to buy something that's very expensive and up. So what I'm seeing right now is people are thinking, well, man, I wish that I would have had more international exposure maybe earlier, and so let's just do that now. And so they're selling off a portion of the S&P 500 or the NASDAQ 100 or something and buying into the international funds today at their all-time high while they're beating the US market, and that's just the wrong time to be doing this. The move would have been to have been invested in some of these international ETFs maybe a year or two ago or something if that works for your portfolio, but definitely not today. So the strategy here would be to educate yourself on learning if it is something that's important to you to have some international exposure for the long term of your portfolio. If that's the case, if you think, yes, I should have a portion of it purely international, if so, wait until the scales get back into alignment, wait until we get through all these geopolitical and tariff and trade issues, and then add in some cheaper priced international at that point. The next stock is actually up over 82% in the past year and could legitimately go up 50, maybe 100 times from where it is right now, and that's why a bunch of people have been pouring into it. But first, thank you to Investing.com for being the sponsor of today's video. Investing.com is the go-to financial website that many of us have been using daily. When you subscribe as a member, you get access to ProPicks. ProPicks uses artificial intelligence to analyze the market and gives you a list of the top investment opportunities. What I love about ProPicks is that it saves me a ton of time. Instead of spending hours researching stocks, I can now check their picks and make informed decisions in minutes. One of my favorite tools is this Warren AI tool. For this video, I asked it if I should invest in Nvidia stock. It gave me solid pros and cons and ultimately agreed with what I said earlier in the video. Nvidia is a global AI powerhouse with world-beating growth, but much of that optimism is already in the price. For investors, this is where legend meets lofty expectations, sky-high potential, sky-high risks. As an Investing Pro member, you don't only get access to ProPicks, but a whole suite of other powerful tools. For example, there's an ideas section where you can look into and copy the strategies of legendary investors like Warren Buffett. Now, the absolute best part is that Investing.com is running a summer sale of 50% off, but I managed to get an even better discount for you all to add an extra 15% off, but only until the end of July. Click the link in the description to subscribe and start using ProPicks today. This offer is only available for a limited time, so don't miss out. Now, next on this list would just be over-speculation into certain specific stories that are being told. Two big ones in transportation innovation are in the space of disrupting the travel industry, which is definitely a very, very lucrative place. Like if someone gave you a chance to go back to 2009 and told you that this year a company called Uber is going to try to disrupt the taxi industry, would you invest? Well, these companies are trying to take short-term travel to the next level by introducing this idea of sort of individual helicopter-style travel to transport one from city to city faster. Joby Aviation and Archer Aviation are pioneering companies in the emerging urban air mobility sector. Both are developing electrical vertical takeoff and landing aircraft designed to revolutionize short-distance travel in and around cities. Both aim to reduce urban traffic congestion, enable sustainable, fast urban mobility by transforming 30 to 90-minute commutes into 10 to 20-minute flights, and establish a new layer of point-to-point air transit beyond traditional helicopters and taxis. As you can see here on the chart that I made, here are some of the benefits and also risks. There's a lot of very cool things and reasons to invest. One of the big things that I saw right off the bat was the partnerships with legit huge companies. Like Joby Aviation has Delta, Toyota, Uber, and the Air Force, while Archer has United Airlines, Stellantis, Anduril, and Palantir. They also have major cash behind them. $1.4 billion in cash for Joby and $2 billion total raised by Archer. But take a look at those risks. Joby's still burning about $500 million annually, Archer still has no top-line revenue with substantial quarterly losses of about $100 million per quarter. There's also regulatory uncertainty. There's criticism from short sellers and questions over FAA-compliant transition flights, so the risk is big there. There's also crazy competitive pressure. They face competition from companies like Lilium, Whisk, and others, making market share a major battleground. So all in all, one can invest in something very speculative like this, and with all of that good news, all of those good benefits that we saw in the chart, it does sound like something that does seem like it's going to happen, and that it has backing from legit companies, it has a lot of money, it definitely has the technology to be able to do what it says it's going to do. You just have to be careful with those risks. What I'm seeing people do wrong in their portfolios is that they're not just speculating in 1 or 2 companies, they're speculating in like 5 or 10 companies, and now that's 30 to 40% of their entire portfolio in speculation. More often than not, these do not pan out. So what I tell my clients is, I don't want you in more than 10% of your entire portfolio in something very, very speculative. Now next on the list, number 4, is something that is very understandable as to why people are investing in these, especially right now. It's no secret that Bitcoin is becoming more and more valuable and will become more and more acceptable and usable in our world in the next years. Whether you believe in Bitcoin or not, our world is definitely getting more and more digital, specifically in the world of finance. Like, when's the last time you actually used cash? And so anything that makes it even easier, faster, and takes the middleman out of it, that's something that's going to definitely play out in the next couple of years. Instead of investing in any one crypto like Bitcoin or Ethereum or XRP, why not just invest in a company that houses all of them, or invest in a company that holds Bitcoin as a strategy? I'm seeing way too many of my clients with way too much exposure and hope around companies like Coinbase and crypto-linked names like MicroStrategy. These have been propelled by cryptomania but face regulatory and market headwinds. MicroStrategy is tethered to Bitcoin and could collapse if crypto prices drop. Coinbase is likely seen as vulnerable due to tightening crypto regulations. Honestly, I personally just like Bitcoin a lot better than these companies that are trying to have a strategy around Bitcoin or with Bitcoin, or any of the other cryptocurrencies. I do see a world where Bitcoin makes a lot of sense, and so I'd rather just have the actual asset. And as far as companies or indexes that are going to hold that risk for me, but maybe mitigate the risk better, I would rather just hold QQQM or SCHG or VUG, some of these types of growth style ETFs that are going to house things like Coinbase or MicroStrategy, or these types of companies that are going to be the crypto juggernauts in the future, but I don't have to pick the absolute winner. My risk is spread out between a whole bunch of other growth companies, and so if they do good, great, I make money. If they do very, very bad, it doesn't decimate my entire portfolio. So that's the way that I would rather do that. All right, the last one on this list, number 5, all centers around this idea of opportunity cost. Through all this volatility this year, and especially when the whole stock market dropped big in April, people were very happy that they had a portion of their portfolio in stabilized funds like bonds or cash equivalents. The sting of that huge dip still is lingering and should be respected. But what I'm seeing right now in portfolios that are lagging overall is that people have way too much money in defensive areas, or just holding way too much cash off to the side. During that big dip in April, I came on here and explained to everyone that I would be buying even heavier during that time. Those that did that same exact thing, instead of keeping all of their money off to the sidelines, have seen monster returns because of it. In April, the S&P 500 or SPY was around $500, and now in mid-July, it's about $623. That gain is 20 to 24% just in a couple months. And for the NASDAQ 100 QQQ or QQQM, in early April it was at about $460, and now it's at $554 or so, which is a 28% gain had you just been investing and keeping on buying that dip. Overall here, for the year to date for 2025, you can see that the S&P 500 is up about 7% in total for the year. The NASDAQ Composite about 6.6%, Dow Jones 4.3%, and those bonds are up 3.2%. So yes, during that time, bonds kept everything safe, and so when the S&P 500 dropped 15% or so, that was, and it did look like bonds were the move to stay into, and at that point it was. But what you should have done, and what I definitely did, is take the cash or anything off to the side and throw it in at that point. It's not meant to just hold it forever, because now the S&P 500 and all those other indexes are absolutely crushing it. And so now having that money in bonds just seems pretty silly. Bonds can be a very important piece of one's portfolio, especially if you're retired or you're living off of your portfolio. But if you're very, very young and you have a lot of years for this portfolio to grow, that's gonna make your portfolio lag so much if you have too much money just sitting off to the side. Like I said before, if you want an extra set of eyes on your portfolio or to discuss the perfect strategy for you, please reach out with my email below at ProfessorG.invest@gmail.com to learn exactly how I invest in my 3-fund portfolio. And most of my clients have been doing the exact same thing and have been seeing amazing results with a super simple strategy. Check out this video here.